Homeowners often sit on a goldmine of equity, but choosing the right way to access that cash can be the difference between financial freedom and a costly mistake. So let us settle the debate between a home equity line of credit and a cash-out refinance once and for all. A cash-out refinance replaces your existing mortgage with a new larger loan, allowing you to pocket the difference in a lump sum, which is ideal if you want to lock in a fixed rate for a major one-time expense like consolidating high-interest debt or funding a large renovation. On the other hand, a HELOC works more like a credit card, giving you a revolving credit line that you can draw from as needed and pay back over time, which offers incredible flexibility if you are unsure of your exact project costs or just want funds available for emergencies. The critical factor often comes down to interest rates, because while cash-out refis usually offer lower fixed rates compared to the typically variable rates of a HELOC, you also have to consider closing costs, which are almost always higher on a refinance. To find out which strategy saves you more money in the long run, visit changemyrisk.com and let's put your home equity to work for you today.